China didn't just make a move, it rewired the global system. While Trump slapped tariffs, Beijing signed the biggest trade pact on Earth, $25 trillion in GDP, 2 billion people. No U.S. signature Gulf oils ditching the dollar Southeast Asia runs on Chinese code, and the West locked out. This isn't BRICS, it's bigger, it's faster, and it's already live. If you think America still runs global trade, you missed what just detonated in Kuala Lumpur. China didn't just attend the Kuala Lumpur summit, it orchestrated a $25 trillion alliance across ASEAN, the Gulf, and its own industrial network, while the U.S. was preoccupied with 50% tariff hikes. This coalition now controls over 2.15 billion people, and a GDP nearly equal to the U.S. and EU combined, yet received almost no mention in mainstream Western outlets. According to Bloomberg, ASEAN's intra-block trade rose 9.4% year-on-year in the first quarter of 2025, and its exports to the Gulf jumped 13%, signaling a silent reorientation. Malaysia's Prime Minister, Anwar Ibrahim, called it a platform of convergence, not confrontation. But the absence of Washington at the table was not accidental. Former Malaysian Ambassador Mohamed Nazari told Reuters this summit showed China is filling the vacuum left by Western tariff threats, not through conflict, but coordination. So if the map's been redrawn, why hasn't anyone in the West noticed? According to IMF figures cited by the Wall Street Journal, China, ASEAN, and the Gulf bloc now contribute over 55% of global GDP growth, making them the largest collective growth engine in the world. ASEAN-China trade surpassed $982 billion in 2024, while GCC-ASEAN trade surged to $63 billion, up 60% from pre-pandemic levels. Vietnam's steel exports to the U.S. plunged 27% this year after Trump's tariff spike. Yet its imports from China grew 14%, a quiet pivot now replicated across the region. In Indonesia, U.S. tariffs erased 5 years of surplus gains in a single quarter. Meanwhile, China's ACFTA 3.0 rollout includes digital trade ESG standards and green energy initiatives areas where U.S. engagement has been limited or reactive. James Chin of the University of Tasmania put it bluntly, China is being given a platform where the U.S. isn't even in the room. But what happens when China's trade corridors stop looking regional and start looking irreversible? When the ASEAN Express freight line from Malaysia to Chongqing launched late last year, it didn't just reduce logistics costs by 17%, it redefined who controls Southeast Asia's industrial arteries. The Jakarta-Bandung high-speed rail, co-financed by China at $7.3 billion, has already carried 9.2 million passengers per data from Indonesia's Ministry of Transport. These aren't just infrastructure projects, they're commitments sealed in steel by embedding itself into ASEAN's supply chain. China transforms regional partnerships into dependencies. And it's not one-way traffic. Chinese firms are offshoring production to lower-cost ASEAN hubs, deepening integration while dodging U.S. sanctions. The Wall Street Journal reported that Chinese green tech exports to ASEAN climbed 19% in the last 2 quarters, driven by joint factory zones. But the real acceleration that's happening where no one is watching. Undersea cables, AI data centers, and 5G backbones, all flowing east. So what exactly is Washington building right now, other than resentment? Let's take a breath, because what happened in the Gulf used to be unthinkable. Saudi Arabia now executes 30% of its oil sales in non-dollar currencies, according to Bloomberg Energy. And the GCC just pledged to raise ASEAN trade from $130 billion in 2023 to $180 billion by 2032, led by Crown Prince Sheikh Sabah Khalid's new investment charter. Simultaneously, Chinese Premier Li Qiang confirmed Beijing would align development strategies with Gulf and ASEAN priorities, signaling a shift from bilateral deals to trilateral ecosystems. Meanwhile, Total Energies inked a yuan-based LNG contract, with China breaking the petrodollar monopoly that's existed since the 1970s. So while Western analysts debate if the Gulf is drifting, China's already docking. The Financial Times notes, Gulf sovereign wealth funds are funneling capital into AI, green energy, and digital finance, all areas where U.S. investment has stalled. But if China now controls the trade lanes and the fuel supply, what's left for the U.S. to leverage? Despite public claims of winning on trade, the U.S. has signed 0 formal binding trade agreements under Trump's second term. The Phase 1 deal with China, never ratified by Congress, has seen China miss agricultural purchase targets by over 28%, with no enforcement penalties. The Peterson Institute reported U.S. tariffs have cost the economy more than $300 billion since 2018, while failing to reshore industrial capacity at scale. In contrast, China is spearheading legally binding multi-sector frameworks, RCEP ACFTA 3.0, and the upcoming GCC China Free Trade Agreement expected by mid-2026. China, Canada, and Mexico, once cornerstones of U.S. regional trade, are diversifying toward China and ASEAN markets, with Canada's FDI in Asia growing 11% last year according to IMF data. As Washington relies on executive orders, Beijing builds permanent architecture. So ask yourself, who's truly decoupling and who's just being left out? In 2025, Chinese tech giants aren't just selling hardware, they're building digital jurisdictions. Huawei now controls core 5G infrastructure across Thailand, while joint AI labs in Singapore and Malaysia are backed by China's National Development and Reform Commission. According to Bloomberg, China's digital investment in ASEAN rose 28% in 2024, primarily in cloud computing, AI, and fiber optic networks. These aren't simple exports. They're system-level partnerships locked in through 10 to 15-year tech leases, many tied to sovereign data access agreements. Washington's semiconductor bans forced Chinese AI firms to pivot their compute bases to Southeast Asia, triggering a 36% surge in Chinese-funded data center construction across the region, per CBRE. These centers aren't just bypassing U.S. restrictions. They're embedding China into the back end of ASEAN economies. So when the next digital currency logistics platform or smart grid goes online, will it even need Western integration? In March 2025, China and Total Energies executed a liquefied natural gas trade in yuan, bypassing the dollar entirely, the first of its kind. And it wasn't just symbolic. That transaction actually laid the groundwork for what Bloomberg now estimates could become 20% of global energy contracts being de-dollarized by 2028 if current trends hold. Saudi Arabia has already moved 30% of its oil contracts off the dollar, and the UAE now clears yuan in bilateral trade with China's CIPS system, effectively insulating deals from swift oversight. Meanwhile, China's Belt and Road-linked energy corridors, including digital oil payment systems in Indonesia and AI-managed pipelines in Kazakhstan, are linking hydrocarbons to fintech in a way the petrodollar system never anticipated. According to HSBC Global Research, yuan usage in global trade settlements has risen from 2.5% in 2020 to 5.8% in the first quarter of 2025, which is a more than doubling in just 5 years. But honestly, the bigger shift isn't currency, it's control. If energy no longer flows through the dollar, who controls the current? The Kuala Lumpur summit didn't end with a defense pact. It ended with a blueprint. ASEAN, the GCC, and China agreed to accelerate a GCC China Free Trade Agreement while upgrading ACFTA to version 3.0, integrating ESG metrics and AI regulation frameworks. According to Anwar Ibrahim, this tripartite alignment now holds $24.87 trillion in GDP, comparable to the US and EU combined. But beyond GDP, it's setting legal templates. The proposed GCC-funded maritime corridor in East Malaysia will bypass both the Strait of Hormuz and US-controlled Pacific choke points, forming a third axis of trade. Professor James Chin called it a model of post-Westphalian cooperation, where legal interoperability replaces military guarantees. Former Ambassador Mohammad Nasri added that China is filling the global governance vacuum with contracts, not speeches. So, if ASEAN, the Gulf, and China can standardize trade law, tech governance, and investment arbitration, who still needs WTO-style arbitration to settle disputes? Vision 2045, ASEAN's strategic roadmap unveiled at the summit, sets targets for digital economy integration, legal harmonization, and industrial cooperation zones. But execution remains the biggest variable. According to McKinsey, intra-ASEAN trade still sits at just 23%, far below the EU's 65%, largely due to customs inconsistencies and fragmented digital infrastructure. While Gulf sovereign wealth funds pledged over $50 billion in new capital implementation, hurdles ranging from land acquisition delays in Vietnam to AI regulation gaps in Brunei threaten momentum. China may offer financing, but governance capacity is uneven across the bloc, and geopolitical pressure looms large. A leaked EU Council report seen by Reuters warns that the ASEAN GCC China nexus may redefine trade alignment in the Indo-Pacific and push Brussels toward digital decoupling if legal frameworks diverge. The ambition is real, but the gap between diplomatic consensus and institutional execution. That's where the alliance either crystallizes or cracks. If you still think BRICS is the biggest threat to the Western-led world order, you're missing what just happened in plain sight. This isn't just another bloc. This is a parallel architecture built on digital rails, powered by Gulf oil and coded in Chinese infrastructure. But here's what no one wants to say out loud. If this alliance works, it won't just reduce reliance on the US. It could actually redefine what a global economy looks like without it. So tell me, do you think this new system has what it takes to last? Or is this just another summit-sized illusion? Drop your thoughts in the comments. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.